Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, December 14th, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week. This week's quote is from Brigham Young. He once said, "If you wish to get rich, save what you get. A fool can earn money, but it takes a wise man to save and dispose of it to his own advantage." Those are some wise words from Brigham Young. Well, we are definitely not out of the woods yet, but today, on Thursday the 13th, you would think that everything was calm and pretty peaceful. But the regional banks got pretty roasted today. The Russell 2000 small cap index got hit pretty hard. And if you just watch the mainstream TV channels, you would think that, oh, hey, the Dow Jones Industrial Average was up 70 points. But the last 3 days, it has clawed and scratched and tried its best to climb up out of its little funk that it's in, I guess you could say, and it just keeps struggling. The Dow was up a few hundred points on Tuesday and gave most of it away. It was up pretty good on Wednesday and gave most of it away. And today as well, it just kind of fizzled for most of the day. And at the very end, it squeezed out a little rally. But behind the scenes, banks are falling, home builders are falling. There is a lot of destruction going on in many sectors of the economy. And I just want you to pay attention and be aware of the risks, because every single entity out there wants the Dow Jones to look good, because that's what the people watch on TV. But if you watch what the other indexes are doing, you might just find a few clues hiding under the surface. So be careful with your money, and let's jump into those charts, and I'm going to show you the Dow and S&P 500 and a few industry sectors to make my point. Well, let's go ahead and get started, beginning with the Dow Jones Industrial Average. Looking at this chart of the Dow Jones Industrial Average from December 1st, 2017 until today, you can see that we're still down here in the bottom after a big sell-off that began on December 3rd and bottomed out here on December 11th. We had a couple days this week of a bounce. So the Dow is still looking very weak down here, and in fact you can see that on the short-term indicators. The 5-day moving average in red is back below the 20-day moving average in blue, and both moving averages are pointing down. The fact that the 5-day is below the 20 tells me that we have a lot of short-term weakness, and if we switch it to an intermediate term indicator, then we have the 20-day moving average in blue below the 50-day moving average in purple, which means that for the last several weeks, the trend has been down, and which you can obviously see. The Dow Jones Industrial Average peaked on October 3rd, and here we sit down here in the bottom on December 13th, which would indicate why these moving averages are both pointing down. So right now, the Dow Jones is looking very weak, and I'll use the word bearish, but for the last 2 days it has been able to save itself for a little bit longer, and I'll just show you what I mean. And for that we have to zoom out to January 2016. The trend that the Dow Jones is currently in began right here, and I'm going to switch this over to a candlestick chart right over here. There we go. And if we draw a line from the low of February 11th, 2016, and we draw that up just like that, you will see that the Dow Jones Industrial Average made this low right here, February 11th, 2016, made a second point, November 4th, 2016, and that was the day of the election. And if you draw a line connecting those two, you draw it up, and I'll zoom in again to the last few months. You can see that the Dow Jones Industrial Average came right down on October 29th, tagged that line precisely, bounced off it, came up here, made a high on November 8th, came back down, hit that line and broke it barely just for one day, shot back up again, and then came right peaking on December 3rd, and then came back down again. And if I zoom in even closer, you can see where we stand today on the Dow. The December 6th, we broke that 2.5-year trend line, but closed above it, saving it for the day. December 7th, we broke it and closed below it. That is a very bad sign. That is very bearish. And then even worse, on December 10th, we broke that and headed lower with a lot more force and closed near the high of the day, but still underneath the trend line that was broken. And on December 11th, this week, we opened the day like up 300 points or 400, something huge. But as the day went on, the Dow Jones Industrial Average completely collapsed on itself and closed right here at the bottom of the red box. So for 3 days in a row, the Dow closed below that 2.5-year trend line that was broken, and that is not a good sign. However, on Wednesday this week, December 12th, the Dow shot up again like 300 points and then closed at the lows of the day again, but closed just above that red trend line from the last 2.5 years. So it saved itself on Wednesday this week. And today, which is recorded on December 13th, Thursday, the Dow got up like 100 points or so, came all the way back down, broke below that red line again, and was able to save itself for a second day, closing back above it. So right now, the Dow is struggling to get up in the upward direction at all, and it is really having a hard time. So caution needs to be used in this situation. This particular index is really struggling, but you can see that the 2.5-year trend represented by this long red line was broken and closed below 3 days this week, which is not a very strong sign. And it's not strong at all. It's a very bearish sign. So let's take a look at the S&P 500. Looking at this chart of the S&P 500, you can see that it looks very similar to the Dow Jones, and we are still sitting right down here in the bottom. However, the S&P 500 is weaker than the Dow Jones, and let's start off with the indicators. The 5-day moving average in red is nicely below the 20-day moving average in blue, and in fact the 5-day moving average in red has made a lower low compared to its 5-day moving average of November 27th and October 30th. So that is not a good sign, even though you can see the price of the S&P 500 has been pretty consistent between October 29th, November 23rd, and December 7th. So it keeps bouncing off that same level. However, let's go ahead and zoom out, and I'll show you what the big problem is with the S&P 500. Going back to the same February of 2016, you can see if we connect these points, just like that. And let me change this to a candlestick chart real fast because I need to. And yeah, that's about it right there. So in this case, the Dow Jones Industrial Average is still holding on to this red trend line from February 11th, 2016 until November 4th, 2016, and drawing it up. You can see we hit it once here in February of 2018, hit it a whole bunch of times in March and April of this year, and also in May, and then we broke it in October this year on the 10th, and rallied up, touched it, collapsed, rallied up, touched that red line, which is now resistance because it's broken. We collapsed again, rallied up again one more time on December 3rd, and collapsed again, and here we sit. So the Dow Jones is still holding on to that 2.5-year trend line, but barely. The S&P 500 is not even giving it a chance. I mean, the S&P 500 is completely broken Here it is sitting down here well below the trend line by like 5%. So S&P 500 is extremely weak, and that is because there is 500 stocks in the S&P 500, and a lot of them are under tremendous amounts of pressure. The Dow Jones Industrial Average is only 30 stocks. So in order for the Dow Jones to look really good, you just need to make the 30 stocks look good, not 500. So it's hard to hold back the gravity that's pulling on the S&P 500 in this case. And I will show you real quick what that gravity is in the specific industry sectors coming up right here. Looking at this chart of the Dow Jones Transportation Stock Index, which is composed of airlines, railroads, marine, shipping services, delivery services, this index is under a tremendous amount of pressure, and it is a very strong reflection of the U.S. economy going forward, is what this is all about. If we don't have if we have a declining economy, we tend to see declining transportation stocks ahead of it. And right now, you can see that this particular index peaked on September 14th, bottomed out here on October 29th, bounced into December 3rd, and then collapsed like a rock. And this is quite a amount of drop for this index. In fact, if we measure the high to the low, it's 16.7% is how much this index has dropped in the last 3 months, which is very, very stunning. This is not the only index under pressure, though. Let's take a look at the financials. Looking at this chart of the Dow Jones Financial Stock Index, which is just like it sounds. It's a bunch of banks and their component stocks in this financial index. You can see that just like the Dow Jones Transportation Index, the financials are falling rapidly. They peaked back here at their all-time high, or I don't want to say that. I don't think it is the all-time high, but peaked this year on January 26th, and then tried to make another high on September 20th, and then it just rolled over like a stone, bottoming out October 24th, rallying up, and then collapsing down here to where we sit today on December 13th. Let's measure that decline from the high here of September to the low of today, and that is a 12.3% decline for the financials stock index. And if we look at the regional banks, you will see a lot of weakness there as well. These financials in the Dow Jones Index are national banks. Let's look at the regional banks. This chart of the Dow Jones U.S. Regional Bank Stock Index. These are smaller banks, and this chart shows that there is something not quite right in the U.S. economy as we speak. These banks are typically not as well capitalized as our big national banks. These are much more sensitive to the local economies in which they serve. And boy, you can see that this thing is just getting pounded. This chart is from December 1st, 2017 until today, and the acceleration is getting faster and faster every month that goes by. And if we measure the height of this decline from the most recent high anyway, from August 21st until today, the regional banks are down 20.5% since August. That is huge. And let's wrap it up by taking a look at the home builders and see how those are doing. Here's the chart of the S&P 500 Home Builders Stock Index, and you can see that this is not looking good either. The home builders are under tremendous amounts of pressure, and the pressure continues to the downside. And this is not a sign of strength in the home economy, or I should say the residential real estate or the home builder economy, whichever what you want to call it. Right now, this particular index is showing no sign of life at all, And if I measure the high of this day back in January 22nd, 2018, let's take a look at how far this index has fallen since January. As of the recording of this video on December 13th, this index of home builder stocks is down 28.7%. That is absolutely stunning. You would never know by watching the TV that this is currently going on with regional banks, national banks, home builder stocks, and the overall market in general. But right now there is some strange stuff going on out there that is not being represented effectively by the Dow Jones Industrial Average. There is one possible bright ray of sunshine here, and that is the U.S. 30-year Treasury bond index. And you can see that it has been in decline. 30-year bonds have been in decline in price since September of 2017. And you can see, at least in the near term, that they have hit a bottom November 2nd and November 8th. And because the stock market was having some problems over this period, it appears that bonds are catching some favor because the bond price on the 30-year has in fact risen by how much? Let's take a look. I measure that. It's about 5.2%. So bonds are going up, which means interest rates are going down. For the moment, however, bonds are not out of the woods yet. Obviously, you can see that bonds have been in decline since September of 2017. Well, what do I mean by not out of the woods yet? Let's go ahead and draw a line across the tops here, and you will see exactly what I'm referring to when I connect those highs. Well, we have the high of September 2017, touches perfectly the high of December 15th, 2017. And as of this week, we rallied up from November 8th up to here on December 10th, 2018, and hit the red line and turned down. So the jury is out for the rest of December. Can the bonds break through that red line and go higher in price and lower in interest rates? And we will see where we go over the next few weeks. But for the moment anyway, bonds caught a nice little run here for a few weeks, and were stopped by that 1 year and 15-month trend line. Thank you again for watching this market update. Before you go, please do me a favor and click the subscribe button on the YouTube channel, and then click the little bell next to it so you'll be notified whenever additional videos are posted. And in the top right-hand corner of christensenwealth.com and in the summary description of this video, you will find links to the Facebook, LinkedIn, and Twitter pages for Christensen Wealth Management. Please visit those when you have time and like or follow them while you are there. Well, have a great day and a great week, and remember that getting back to even is not an investment strategy. So please do me a favor and keep an eye on your hard-earned money. Protect your retirement in these volatile times and preserve it for days when you can buy great investments at much cheaper prices. See you again in about another 7 days. Bye-bye.